Welcome to another lecture of iedubook.com. This is lecture number 1734 of accountancy. And today we are going to learn about bank reconciliation statement, how to prepare a bank reconciliation statement when you have to start with the debit balance of the bank passbook. So let's say your starting point is balance as per passbook debit. Again, let's say this is 20,000. Okay. Now please note that this balance which is given to you is actually after taking the impact of all the transactions for which the adjustment is given. And let's say you have a cash book. Right? Now let's say if I tell you one transaction, I'll give you actually two examples. The first one is interest credited by bank. So let's say if I tell you the bank has credited an interest of 100 rupees. Now when we talk about interest credited by bank, let's say you have a passbook. And a cash book. Let's say the starting balance of this passbook was X and X here. Right? Or let's not take it like this, probably. Because you're given that it's a debit balance, so I will take X as a debit balance. Okay? And cash book can be positive or negative, but for the sake of consistency, let me take it as X. Now when the bank credited interest of rupees 100, it would have credited the account here by interest, right? So what will be the balance which is left in this account? You had a debit balance of X. You were credited by 100. So the balance has to be what? It has to be X minus 100, right? Whereas the balance in the cash book, because this entry has not been passed, would remain at X only. Why? Because there's no impact of this entry. My starting point is what? My starting point is the passbook. So I have to take this X minus 100 to X. How do I do that? By adding 100, because the moment I add 100, 100 cancels out this and the two balances become equal. So interest credited by bank will actually be added. Right? Now similarly, let me take another example. Maybe I'll just rub off these things from here. In this case, I am taking an example of check just give me a sec. Deposited, not credited. Now if you come to think of it, let's say this balance is 200. Okay. When I say that a check has been deposited, what does this mean? This means that the entry would have been passed by the company in cash book, and if it deposits this balance, what will it do? It will debit the person who's given the check and make this 200. Whereas no entry is passed in the bank passbook. So what will be the balance in the cash book? Cash book was started with a credit balance. There's a debit of 200 here. So the balance will be X minus 200. Whereas in this case, the balance remains at X. But the prima facie condition is these two have to be equal. So if I have to take to X minus 200, what do? I'll simply subtract 200 from X and I will get X minus 200. So this entry will be subtracted. Isn't this pretty simple? So just keep these logics and small things in mind and you'll be able to solve all the problems relating to a bank reconciliation statement.